Good afternoon, everyone. This is Chuck Self, Chief Investment Officer for iSectors. I'd like to thank you for joining us today to review the iSectors fourth quarter 2014 performance updates. I will be providing a brief fourth quarter performance overview of all the iSectors models and conclude with our near-term economic perspective on the markets. This call should last about 15 minutes with questions and answers to follow. Please feel free to ask questions anytime during or after the presentation by clicking on the chat box in the upper right-hand corner of your screen. This presentation will be recorded, and a copy will be available on our website tomorrow at www.isectors.com. Just click on the iSectors blog icon when you get there, and it will take you to a link to access this recording. We will also be sending a link to access a recorded copy of the presentation to all webinar attendees immediately after this call. The post-MPT allocations benefited from a positive market in the quarter, outperforming the benchmarks. Healthcare and finance exposures continued to help performance. Although the allocations have not changed much in the quarter, we have seen a continuing decline in energy holdings. Growth is overweighted in healthcare, finance, and technology, and moderate is overweighted in healthcare and finance with some treasury holdings. Post-MPT growth continues to be ranked 16th among 670 ETF strategies for one-year performance and 14th for five-year performance in the Morningstar ETF Strategies database. The chart on slide 3 indicates that post-MPT growth usually lags in strong markets and outperforms during moderate and weak times. But even though the S&P 500 was up almost 14% last year, post-MPT growth outperformed by almost 200 basis points. As I'm sure you know, the flip side to the great U.S. equity market last year was the terrible commodity emerging market sectors. Many iSectors allocations were affected by the strong dollar in the second half. The U.S. dollar had a 13% rise during this time. This translated into significantly negative effects on global assets priced in dollars, such as commodities. This also led to a drop in emerging market currencies, given these countries' dependence on producing commodities. Thus, as you see in the chart on slide 4, for the Wisdom Tree Emerging Currency Fund, the fourth quarter was a very difficult one for the investment. Since the liquid alternatives allocation and its portion of the endowment allocation have exposure to real assets, including commodities, these allocations underperformed in the quarter also. In addition, both stocks and bonds, which are used in the benchmark for the endowment allocation, continue to outperform liquid alternatives. Both allocations are broadly diversified and should recover when the commodity markets stabilize. The dollar strength can be attributed to the relatively robust U.S. economy compared to our European and Asian counterparts. Thus, U.S. stocks continue to outperform international equities due to their stronger earnings growth. On the positive side, the equity portions of our domestic and global allocations are tilted toward dividend-paying securities that outperformed growth stocks in the quarter. International bonds were hurt by the stronger dollar's effects on interest payments, especially in the emerging markets. Again, even with the underperformance in the fourth quarter, the iSectors global equity allocation has earned very attractive returns over the past 5 years compared to most ETF strategies and the international benchmarks, such as the MSCI All Country World ex-US Index. In fact, the global equity allocation is in the top 10% of all ETF strategies in the Morningstar database for 5-year performance. The downdraft in commodities had the strongest effects on our inflation protection and precious metals allocations. Thus, as you see in the chart on slide 6, for the Central Fund of Canada, a closed-end fund holding physical gold, November became a very difficult month for the precious metals market. The inflation protection allocation decline was exacerbated by its exposure to the broader commodity market, especially energy, but was helped by a rebound in real estate investment trust holdings. Although we are glad to see the strong start for precious metals in 2015, we are cautious due to the ongoing US dollar strength. At these relatively low prices, you may want to consider starting or enhancing a position in either inflation protection or precious metals in your clients' portfolios. As the chart shows on slide 7, capital preservation has earned over 3% on an annualized basis over the past 5 years. The yield is attractive, it has a short duration, and has maintained an investment grade quality on average. Commodity price volatility and US dollar strength in the quarter led to underperformance by the global high yield bonds that are owned in the portfolio. These bonds detracted from performance in the allocation. Finally, the tactical allocations were also hurt by the strong dollar and weaker earnings expectations abroad. You can see the difference in performance between the S&P 500 and emerging markets equity ETFs in the chart on slide 8. The tactical global balance allocation is 60% invested in a variety of asset classes. The tactical international allocation has an 80% cash holding waiting for international markets to turn. As far as our economic outlook is concerned, equities have struggled during this period of high volatility in the energy markets. The negatives of the oil price drop are apparent earlier than the benefits to our economy. We expect those benefits to show itself in the upcoming quarters. In addition, lower interest rates have resulted in a spike in mortgage refinancing since the holidays, which will also help consumer spending and help repair balance sheets. These factors, along with many others, support our quantitative model's bullish stance. And once we get through the upcoming central bank meetings, and if oil stabilizes around current prices, then if that happens, we expect that generally strong fourth quarter earnings reports will push the stock market to new highs. We will now begin the question and answer portion of the webinar. If you have any questions, please type them in the chat box in the upper right-hand corner of your screen. We have a couple of questions to start with. The first one is, do you think the oil price decline may end up leading to deflation? Our view is that the oil price decline is very much an oil market related phenomenon. Although other current commodities have also declined in this period of time, as I just explained, we've seen gold prices go from under $1,200 an ounce to over $1,300 an ounce. And so it's likely that the strong decline in oil is much more a supply situation than a result of the lack of demand. And as you well know, there's been new sources of supply both from US and Canada and other places over the past couple of years that have contributed to the supply. So we do not think that this is the start of a new deflation. We think that interest rates have probably overplayed its move down and should probably be in the 2% plus range for 10-year treasuries. And so we don't think that the strong U.S. economy that we've seen in the numbers for the third quarter and most of the numbers for the fourth quarter will be derailed by the oil price declines. Another question has come in: what's the downside protection for post-MPT portfolios? As we showed at a chart towards the very beginning, and it may not be very easy to see, but you'll be able to look at it when you look at the replay of the presentation. We'll be happy to send it to anyone that's interested in it. When the market has gone down, the post-MPT growth has outperformed the S&P 500 100% of the time, and on average has only captured 40% of the loss. This is because, unlike other equity strategies, post-MPT growth has the ability to own sectors that are not in the S&P 500, including gold and long-term treasury bonds. And so it has the ability to actually profit from what is going on in sectors outside of the 10 equity sectors when they do not look attractive. We have a third question: will a strong US dollar hurt the prospect for the post-MPT models at all going forward? Obviously, the strong US dollar has hurt the energy portion of the equity markets. The energy was by far the worst performing sector in 2014. We have had small energy positions. Our models indicate to us is that when the economy is growing like this, energy should benefit, but obviously the supply situation in the energy sector has overwhelmed the demand side. But we do believe that once we have stabilization of oil prices, and there are companies, and the companies that are the large companies in the energy sectors and the ETFs that we own, that they will figure out how to benefit from the downturn that has occurred, and we'll start seeing positive earnings surprises in the energy area. As far as the strong US dollar and other areas, there are multinational companies that get much of their earnings from abroad, but the sectors that we have overweighted for the most part are exposed only to the US markets, and thus that's why they've been able to perform well even as oil prices have gone down. Are there any other questions that anyone else has? One more. No, this is the same question as far as downside protection for post-MPT portfolios. I will say that on average for the post-MPT growth, it tends to have, like I said, about 40% capture of the downside, whereas the upside capture is in the 60 to 70% range. I would like to conclude this seminar by thanking everyone for attending the webinar this afternoon. If there's anything else we can do to assist you with your wealth management or 401k asset allocation needs, please let us know. We can be reached directly at 800-869-5184. Again, thank you, and we hope you all have a successful 2015.